Hello friends, today is 30th December 2016. So to my all viewers and to all my subscribers, happy new year in advance. Wish you a profitable year 2017. So today my video is on current news of Financial Minister statement, which states that Mauritius based entities that invest in India from private equity investors or venture capital funds or investor pass-through vehicles, which is through participatory notes, will start to see taxation applies from them from April 1, 2017. And this treaty change between India and Mauritius. So okay, here is a deal simplified with one example for you. So I am giving you one example. So watch my video till the end to get proper knowledge. So currently, if you are a foreign investor, you can invest in India companies, both listed and unlisted. So when you sell them, you would pay capital gain taxes in India. So, and some of those gains are withheld before you get the money. So you have to pay the tax to India. But till now, there were many double taxation avoidance agreement, which is called as DTAA, which are treaties between India and certain countries that allowed a certain type of gain, capital gain on the sale of shares and property, to be untaxed in India. So this applies to entities coming from Mauritius, Cyprus and Singapore. So if you are bought the shares and money through a Singapore, Mauritius or Cyprus route, then the sales shares would be taxed at a tax that will not be taxed at all in India, since none of these countries charge capital gain taxes. Mauritius was the easiest way till now. All you had to do to get zero tax on your investments, both listed and unlisted, was a simple to sell entity in Mauritius. The tax treaty didn't differentiate between a company that actually operating in Mauritius versus a company that was only to set up there to get just tax benefits. So for a few $1000s, you could get a Mauritius entity and invest it to the Indian stocks and shares and never pay capital gains tax to anywhere. Why not Singapore? Now we will talk about Singapore more. Singapore had both objective and subjective restrictions on who got the treaty benefits. For one, the Singapore entity needs to spend Singapore dollar, that is $2 lakh Singapore dollar in a year in Singapore, an amount that would easily detect the tax shopper from cheating, creating such entities only for tax benefits. Subjective, the rules also exist which can disallow a company if the tax authority feels the entity was created only to get tax benefits. So Mauritius was the easiest way to get through and get tax benefits. So Mauritius was the easiest way to create your little tax evidence intermediary, and scores of people use it. Almost all the big banks have a Mauritius intermediary that owns shares either themselves or on behalf of customers with them, at a primary advantage being tax. So but it's hardly to place to be really wealthy person. It's not bad country. Mauritius is not a bad country to live in, but it is the place to where really wealthy person can live in. So conclusion of my video is, from short term we can see in Indian stock exchange a little liquidity crunch, but for long term it is very good steps taken for the Indian stock exchange. Thank you for watching my video. Keep watching my video and sharing my video. Please keep like and comment below section. Thank you and cheers.